Why do VCs really care about your sales cycle? It's because it's a direct signal of how fast your startup can scale, test, and return capital. In this episode of Capital Campus, we break down why the sales cycle length matters, how to measure it, and what you can do to shorten it. The sales cycle length, why it matters to you and to your investors. The sales cycle length is one of the most underrated factors that can make or break your startup's momentum. In this episode of Capital Compass, we unpack what it is, how it impacts your business model, and why the VCs care a lot about it. The sales cycle length is the amount of time it takes from the moment you reach a customer to the moment that they pay you. For startups, especially in business to business, this could range from a few days to over a year. Let's start with the type of sales cycles. Now, a business to consumer sales cycle, that is a B2C sales cycle, is fast, it's impulse driven, and it ranges from just a few minutes to days. A B2B, in terms of small and medium businesses, ranges from weeks to a couple of months. But when we are talking about A2B enterprise, it ranges from 3 to 18 months. Shorter sales cycle mean faster cash and data. Longer sales cycle require more patience and capital. Why does a sales cycle length matter to investors? Now you have to understand that venture capitalists think in terms of timelines. A fund might have 10 years to return capital. If a product takes 18 months to close one sale, investors immediately wonder how long will it take to reach 10 million ARRs. So, investors think that the longer the sales cycle, the slower the growth, the more capital that is needed. The faster the sales cycle, the easier to test, iterate, and scale. Also, long cycles often mean complex buyer committees. Higher friction is equal to higher customer acquisition cost, and this also leads to a harder process to prove the traction early on. This brings us to what really affects the sales cycle length. There are a couple of parameters that you should be aware of. For example, what are you selling? If it's a core painkiller, that means it's going to have fast sales. But if it is something that is nice to have or cool factor, that means slower sales. Next comes, who are you selling it to? A sole decision maker or a committee? Budgeted or unbudgeted spend? And this brings us to the switching cost. Does your product require workflow changes or does it require replacing something that's already in place? This means that it's going to be a longer sales cycle. Then come the timing issues. If the other person is locked into contracts, if there is a fiscal year dynamics that is in play, so sometimes it's not about your product, it's about the timing and who you are selling it to. And this is something that you should be aware of as a startup founder. So given all these dynamics, what is it that you can do as a startup founder? First and foremost, choose your initial buyer wisely. Go for fast flow segments to validate quickly. Create an urgency. Use incentives like limited pilots, launch cohorts, or bundled pricing. Cut out the friction. Minimize onboarding or tech integrations early on. And lastly, something that is very important is try to use no-code minimum viable products to sell ahead of full product readiness. Early traction from fast flow segments helps de-risk your startup in the eyes of venture capitalists. You can go after harder enterprise buyers later on, but prove the concept first. So in closing, we can wrap up by saying that know your average sales cycle and what drives it. Use it to guide your go-to-market and capital strategy. For early-stage startups, short cycles are a huge unlock. This is the Capital Compass series. If you're raising, drop in your pitch at pallavisegal.com/submit pitch deck for feedback and review. And subscribe to stay sharp on all things early stage.